As of the time this video is being recorded, there are just under 4,000 publicly traded stocks in the United States. We're going to talk about how to pick one now. Before just picking a stock, you need to have some criteria for what qualifies a stock to be tradable in your plan. One of the biggest considerations when determining whether to invest in something or not is liquidity. Liquidity is a measurement of how easy it is to enter and exit a position. If you invest in an illiquid security, you may have a hard time managing the position properly. For example, let's say we see an option with a bid price of 50 cents and an asking price of $1 per share. If you were to purchase that option at the asking price right now, it would cost you $1. If you had to exit immediately and had to sell at the bid price, you would already be down 50% from your purchase price. So how do we make sure we have liquidity? First, pick an underlying security that consistently has high volume. Higher volume means more competition for pricing and leads to narrower spreads between the bid and ask prices. For option traders specifically, another variable you should probably consider is underlying price. A stock that's too cheap is likely to give you problems with strategy selection. You may find yourself limited to single leg strategies, for example, if you're using cheap stocks. As a general starting point, when selecting a security to trade options on, try to stick with stocks that are trading for at least $20 per share and average at least 3 million shares per day. You could take this a step further if you wanted by trying to stick with options that have a bid price within 10% of the asking price. Stock investors could probably be a little bit more relaxed with their criteria, but should still make sure that the stock they're choosing to trade is a liquid one. So now that you have some starting requirements for selecting a security, let's talk about how to pick one. With thousands of stocks, thousands of ETFs, and thousands of index funds to choose from, it's important that you simplify the process here. If you're a longer-term investor, you should probably take the time to research carefully any investment that you're considering. Fundamental analysis combined with any other criteria you're including should never be taken lightly. For a short-term trader, this is theoretically easier in the long run. Eventually, as a short-term trader, you could build a list of stocks that you watch regularly, and you just trade the same stocks over and over again. You'll begin to recognize the way the stock trades, identify key support and resistance levels, be aware of upcoming events, and learn about any other patterns that the stock may follow. At first, though, you may want some ideas for what to trade. I'm going to suggest 3 different techniques for how to find a stock. The first technique is what I call the eyeball approach. Peter Lynch, the man who ran the Magellan Fund for Fidelity, had the best 20-year return of any mutual fund manager in history. He is famous for saying, know what you own and know why you own it. As retail investors, that translates to investing in what you're already familiar with. For example, do you have a product or a service that you just love and you recommend it to others? If so, you should probably be an owner of that company and try and profit from the advertising you're doing for them. Or let's say you're an expert in the semiconductor field. Well, you probably know which companies are likely to do best, and you probably also know which companies are likely to do worst. Don't make picking a stock hard, just trade what you know. A second technique would be using screeners or scans. There are many services that will scan the market for you. You can select criteria you're looking for, and the scanner searches for securities that meet those criteria. Well, this is convenient, but don't forget you still need to do proper research, such as checking for earnings or other announcements before you actually place a trade. A third approach for finding a stock is doing top-down analysis. Top-down analysis is a method wherein you first determine the overall direction of the market and then look for the sector leading the way. Within the sector that's leading the way, find an industry group that's leading the sector, and then within that industry group, search for an individual stock that's leading the industry group. Well, there you have it. Those are some minimum criteria to consider before trading, as well as 3 different techniques for how to find a stock.